Welcome back to Boss Economics World, where we boil down the most confusing economic blunders and serve them piping hot to you. And boy, does the European Central Bank, ECB, deserve the roast of a lifetime. Look, know you've heard it before: inflation, recessions, rate tweaking, the euro wobbling around like a dodgy cryptocurrency, and now, they're trying to tell us their monetary policy might no longer be restrictive. Yeah, let that sink in. The very institution that's been pushing interest rates like a seesaw, but way less fun, is suddenly scratching its head, thinking maybe, just maybe, they're no longer kneecapping the economy. At the heart of this whole mess, we've got what's shaping up to be another quarter-point rate cut, possibly dragging borrowing costs down to 2.5%. The big question, is this the neutral rate we've all been waiting for? Or is this just the ECB taking another wild stab in the dark? Christine Lagarde and her merry band of monetary policymakers seem to think that they're threading the needle between economic stimulation and economic strangulation, but is that really the case? Stick with me, and we'll tear this apart from the roots, laughing all the way through the fiscal jungle. The ECB's newest debate about no longer calling their monetary policy restrictive is a startling admission of, well, confusion. For months they've been trying to fix inflation, first with rate hikes, then with cuts. Now, with rates likely falling to 2.5% in March, they think that it might not be restrictive anymore. It's like watching someone try to read a roadmap upside down, and, surprise surprise, Lagarde's latest statements don't exactly gleam with confidence. While it sounds like the ECB is acting with precision, the reality is that they're using what economists love to call educated guesses. They don't want to admit that figuring out the neutral rate is like playing darts in the dark. It's almost impossible to pinpoint, and high risk if you miss. Now, why is this such a big deal? Because the neutral rate is supposed to be that magic Goldilocks number, neither too hot, nor too cold, just right. Historically, the ECB has been throwing out numbers from 1.75% to 2.5%, with Lagarde just last week narrowing it down to 1.75% to 2.25%. Are these numbers based on careful analysis or more speculation? The fact remains, although they want to control inflation, it seems they can't even quite define what's normal in this topsy-turvy economy. Let's put it plainly, inflation is still the villain of this story, and the ECB is playing a risky game. Inflation across the euro area has been on a roller coaster, and now that it's not surging quite as aggressively as earlier this year, they seem to be waving the mission accomplished banner. But hold on a minute, does a slightly lower inflation rate really mean we're out of the woods? Here's where the ECB missed the plot: inflation doesn't just leave the room because you cut rates a few times. Global supply chain issues, energy prices due to geopolitical factors, Russia-Ukraine war, and other externalities don't magically disappear because borrowing rates dip to 2.5%. Real-life data is showing cooling inflation across Europe, but that doesn't mean businesses are ready to operate like they once did. Ask any SME, small and medium enterprise, struggling with costs, it's still a dogfight. Plus, let's not forget the people at the heart of this, the consumers. With higher interest rates over the last year, countless households took a beating on housing, credit card debt, and rising costs of living. Now, after reducing rates slightly, the ECB expects everything to go back to normal. No sir, no economy can just hit reset because of a percentage point here or there. Oh, and speaking of hitting reset, guess what? Europe could very well be staring down the barrel of another recession, potentially one of its worst in decades. Congratulations, ECB, your rate cut knitting project might just weave together a total economic slowdown as businesses, households, and governments choke on the past mistakes of monetary policy. Analysts were expecting this recession speculation to be over, but we've still got plenty of warning signs: sinking demand, weakened industrial output, and shrinking consumer confidence. So, where's the optimistic commentary bubbling from the ECB coming from exactly? Surely not from the real data out there. German Bund futures tumbled, consumer spending is lackluster, and geopolitical tensions are still red hot. Sound like good times to you? GDP growth across the EU has been faltering for months. According to projections, recent quarterly growth has been minimal, while some regions have inched dangerously close to contraction territory. And that's exactly why the ECB is in a panic about keeping rates livable, but also just restrictive enough not to spark off a second wave of inflation. They can't seem to make up their mind because doing so without triggering recession alarm bells requires precision that the ECB clearly doesn't have right now. Countries like Germany saw growth inch close to 0.2% in Q3, while southern European economies like Italy and Spain are putting up similar or even worse figures. Manufacturing output across the EU is still fragile, battered by high energy prices and aftershocks of the global supply crunch. People familiar with these numbers are, at best, calling it a recovery phase, but can we honestly call treading water a recovery? In Brussels, politicians are starting to launch veiled complaints against the ECB's indecision. You've got two polar camps, one pushing for lower interest rates to promote growth, and the other warning of rising inflation from lax monetary handouts. The ECB is attempting to balance these conflicting priorities, but political interests often muddy waters, leading to haphazard decisions. Christine Lagarde's political balancing act certainly isn't earning her many fans, and with election cycles ramping up in several European countries, discontent is brewing. Germany, for instance, isn't thrilled with any notion that rate cuts could continue to devalue the euro, making imports more expensive, not great news for a country that imports a massive amount of raw materials. National politicians, especially the right-leaning factions that are critical of the EU's handling of financial matters, are turning up the heat. With populist movements gaining steam across Europe as frustrations soar over economic stagnation, we could be seeing more clashes between monetary policy and elected officials. It's not just Europe that's watching the ECB with fingers raised to their temples in confusion. Onlookers from the Federal Reserve, the Bank of England, and even China's central bank are scratching their heads. The ECB's current indecision risks creating a domino effect through the global financial system. Global stock markets briefly reacted to hints of the ECB's policy shift, but subsequent uncertainty caused bond and stock prices to wobble. The Fed, which has been on a hawkish stance to combat inflation, is now wondering whether it might need to slow its roll amidst the glaring divergence in European policy. The Bank of England, now grappling with the post-Brexit woes in addition to inflation, must now decide whether to mirror the ECB's relaxed measures or stick to the hard line. And when it comes to China, still reeling from its own pandemic-induced economic hangover, the ECB's rate cuts certainly don't provide much hope for a meaningful recovery in global trade anytime soon. To say that the eurozone economic strategy is in uncharted waters is putting it lightly. Europe is at the crossroads of economic fragility and an impending slowdown, and the ECB is teetering on the edge of irrational optimism. The policy decisions over the coming months will either guide Europe toward recovery or cement its turmoil. With experts predicting a further 3/4-point rate drops through 2025, it's likely we'll see deposit rates stabilize somewhere around 2%. But here's the kicker: if inflation spikes again, or if the neutral rate calculations turn out to be wishful fantasy, they'll be forced to reverse everything, creating a whiplash-inducing spiral for both businesses and households. Already, the euro's market volatility is echoing just how unstable this current setup is. The euro erased an earlier dip in trading yet saw gains wiped out quickly after traders realized that optimism might be premature. Bond markets have fluctuated due to this volatility, and if this waffling continues, expect big disruptions in debt markets, credit loans, and financing mechanisms for European firms. Mark my words, this chaotic ECB policy seesign is a recipe for economic mismanagement disasters. Let me tell you what's at stake. It's not just a bunch of graphs and clickbait headlines. This uncertain monetary policy directly punishes the ordinary worker. When households face tightening credit conditions, job security starts eroding, and economic planning effectively vanishes, Europe is not living in a golden age of growth right now. People are still feeling the pinch. Wages? Stagnant. Prices? Still high. Consumer confidence? Shaken. Right now, folks, the ECB talks a big game about striking a balance between inflation control and economic stimulus, but they're relying on shaky, unproven calculations that don't appear grounded in the day-to-day realities. Until they figure out what real predictability in interest rates means for both consumers and businesses, we'll all be riding the current of their indecision. Strap yourselves in for economic uncertainty, because this roller coaster isn't stopping anytime soon. You heard it here first on Boss Economics World, where convoluted monetary policy makes for great satire, and even bigger risks. Stay informed. Stay skeptical.